Hello and welcome to Hot Money on BloombergQuint Live, India's first digital live streaming business news service. This is a show which gets you a complete wrap of all the stocks which are buzzing in trade. I am Agam Vakil. Let's get in our experts for today. We have Dinesh Rohira of Finance.com and T.S. Harihar of HRBV Client Solutions. Thank you both for joining us here. Well, today on Hot Money, we will discuss Tata Elxsi. Although the stock is down 12% this year, the last 3 months have seen it gain 30%. We discussed this, whether or not the tide has been turning for the company. And with that, we also talk about Just Dial and how the stock price has been impacted due to rising competition. But what's also been working out in its favor is a few off segments. Moving on, we also discuss the asset management companies, and we ask our analysts which among them is the favored one in the long term. We also discuss Info Edge and what does the year have in store for this particular company. And lastly, we're addressing Avenue Supermarts from the retail sector to see whether or not it still remains a good investment bet, despite the fact that we all know that it's been trading at largely rich valuations even after falling from its recently made highs. So, well, let's start by talking about Tata Elxsi. And, well, we do know that what's really happened to Tata Elxsi in the first quarter was extremely weak. But in the second quarter around, we started getting some amount of commentary from the management saying that things are not as bad as as the auto industry is looking out to be. And we all know that Tata Elxsi gets a substantial amount of its revenues from the auto sector. Specifically in this case, JLR, considering their exposure to the company, is about 15 to 20%. I'm going to open this up. Well, Mr. Harihar, I'm going to start with you. What's your view on Tata Elxsi right now?
I think a couple of things seem to be favoring the stock. Number one, I think the specific design CAD/CAM space in the automobile industry that Tata Elxsi operates in, I think it's not exactly as cyclical as probably the auto segment or the auto ancillary segment. They are a lot more cyclical. This is a lot less cyclical because even when the demand is low, people need to plan ahead. They need to plan designs. They need to simulate designs. So I think that is where Tata Elxsi comes in. So I think the impact is understandable due to weakness in their core market, but then it is not as cyclical as the others. So I think that should be positive for Tata Elxsi. Secondly, I think there's a major restructuring we are seeing in the Tata group per se.
Right.
And that includes Tata Elxsi, which is likely to be consolidated with some of either with a part of the auto business or as part of the software business. So I think that is one more thing that is going to work in their favor. Secondly, I think the stock had gone pretty high about 1 year back, and from that level it is corrected quite sharply. So I think at these levels I would believe that the downside risk on Tata Elxsi is very limited. So anybody with an investment perspective of say 2 to 3 years, I think they should bet on this stock very, very strongly as a good bet on the Tata restructuring story.
Okay. Dinesh, where do you stand on this one?
So I would like to wait forward. I do agree that it is a high pedigree stock and good parentage holding from Tata Sons, about 42%. It has a good ROE, good balance sheet, and I mean these are all the qualities in terms of a downturn kind of a business cycle which they're facing right now. But their over-dependence on auto and transport sector, which is almost half of their revenue. So I would want to wait for some more time while it is reasonably fallen down in terms of the EV per EBITDA is about 15.6, which is reasonable, but I do expect some amount of correction going forward. So a couple of quarters, once the results start looking up, is when we look at re-entering into the stock.
Right. But it ever so happens that, Dinesh, that, of course, in the past couple of quarters, the management has been fairly upbeat, despite the fact that they've acknowledged that earnings have not been great. But, it just so happens that whenever stocks are expected to do well, they'll start running up, and of course eventually the earnings will come and they'll show up a good result too. My question then is that would you buy at these levels, or would you want to wait and you wouldn't mind spending a little more and perhaps pay a slightly higher premium, but know that the earnings have started
it's
to
the latter.
come back?
Yeah, wait some more time. Don't mind paying a little more on that and look at the right signs, because the same has been with respect to Tata Motors.
Right.
In the past, we have heard the management talk upwards, but that has not reflected into the outcomes.
Sure.
And if that can happen to Tata Motors, then that can happen to Tata Elxsi also, because it depends a large amount of its revenues from JLR and the rest of the European auto sector.
Right.
So we would prefer that we wait around. Right, it's a high pedigree stock, good management, good parentage, good ROE, good balance sheet. Their cost structures are well optimized.
Sure.
All that stuff is right, but the market conditions have to be appropriate.
Right.
So we won't mind paying a little extra later. It would go back to its earlier highs and so on and so forth.
Sure.
But as Hari rightly said, 2-3 years. So if it's a 2-3 year cycle, then we can wait for 6 more months.
Okay, Ms. Harihar, I'll come back to you on that one as well. Would you mind getting into the stock at this rate, or do you also want to wait for a bit, perhaps a quarter or two, to see that improvement that the management is talking about?
I think the midway we can adopt is probably have a phased approach. So if you have, let's say, X amount to allocate to Tata Elxsi, probably phased over the next 2 or 3 months. So I'm not sure whether how long we should wait, but I think if you phase over 2 or 3 months, you should probably be able to get the best of the volatility in the stock price.
Okay. All right, so, well, it's clear that our experts saying that the long-term prospects are very much in place for Tata Elxsi. But, you have to be just a tad careful, considering the kind of exposure that the company has to sectors which are, which have cyclicality. Even though Tata Elxsi itself has certain other products which are not as cyclical as perhaps the exposure to the auto sector, well, we're going to have to wait and watch on that one. Let's move on from Tata Elxsi to talk about, Just Dial. Now, Just Dial, as we all know, has seen its ups and downs, and God knows that for this particular year as well, it's not been the best of years for Just Dial, despite the fact that it's in the first 3 or 4 quarters of this in the first 3 quarters of this calendar year, it actually did well. It was only the last year or last quarter or the quarter gone by where we started seeing a little bit of deceleration in growth. Last 3 months is declined by as much as 26%, still up as much as 17% in the last 12 months. So the real question is, what do you do with Just Dial? Dinesh, I'll come to you first on this one. What's your view here?
So my view is hold. I'm not too negative, neither positive on this particular stock. The first mover advantage has been somewhat getting lost out with the competition coming into the play, and larger players, global players, direct indirect competition that is catching up.
Right.
In terms of their results in Q2, the traffic also has grown just about 3.2%, right? About 161 million as compared to 156 million. So there is a challenge out there. However, it's a good quality play. They have a decent physical presence across 250 plus locations.
Sure.
And, the traffic is moving towards the app. 80% of the traffic is coming in from the app and all this stuff. So all the pieces are right, but the scale and the growth has got impacted. And so has the valuation also. The valuation also has corrected downwards, right? So it is trading at about 14x or something of that sort compared to competition, which is at about 60 period levels. So I guess we would wait for some more time, and we should also not forget that in the medium term, there could be a potential corporate action that could happen with some of the global players showing interest, which can't be ruled out.
Right.
So I guess all those pieces make a good viewpoint for a hold right now.
Sure.
And as we progress and see some amount of uptick happening or some amount of corporate action happening, then that would make the right case for getting into the stock.
Okay, well, it's an interesting point here that Dinesh has made. It trades at around 14-15 times as against its 5-year average of around 35 times. So it's certainly going at a significant discount to, its historical valuations. Mr. Harihar, where do you stand on Just Dial?
No, we actually have been a little cautious in the stock for quite some time. And a couple of reasons, because when the company started this kind of a database model, I think it was extremely unique. But today, if you look at it, there are a lot of people in the Indian market, and largely I would say global players. Right. Let's say you take the likes of an Amazon or Walmart through Flipkart, or you take someone like a Google. I think they can replicate this kind of a business probably in no time. And I don't know what is the kind of unique advantage they build. Now, to tell you the reason why I don't like Just Dial, I'll just contrast it with another business model, which is India Markets. Now, if you look at India Mart, I think they have taken a very, very niche approach. We'll only focus on traders, on wholesalers, business to business, B2B transactions, and they've been very, very focused, which is one of the reasons I think India Mart has done so well post-listing. Whereas Just Dial, in its attempt to try and become something to everyone, it has become nothing to anyone. So I think that is probably the big problem that Just Dial has. And we have always been skeptical of the stock. It's a very speculative stock. I think the price has fallen from 2,000 down to about 200. It's now up to 500. So we would probably stay off the stock.
We're trying to be something for everyone, and it is just interesting because Just Dial also has exposure to B2B, not unlike India Mart. Dinesh, you want to come in on this aspect of the fact that it's trying to cater to everyone and has been able to specialize? Maybe that is its, perhaps weakness at this point?
So at this point in time, it's right. But having said that, if you look at the global players as well, right, they also end up doing anything to everyone. So the local market search engine, if I would have to call it that way, right? So that level of quality which somebody would want to acquire at some point in time, or they may want to monetize that very well, that can come into action. And I would not write off the asset or the quality that they've built so far. It would be value to them in terms of driving the business forward, or it could be a corporate action at some point in time.
Sure. Okay. All right, so slightly varied views as far as Just Dial is concerned when it comes to our experts, but let's move on to the third stock. And of course, we are also in this case considering not necessarily just a stock, a subsector, if you can call it that. That's the asset management companies. Yesterday we actually saw a little bit of a knock on asset management companies, but notwithstanding that knock as well, we've seen good strength come through around here. So let's take stock of how things are panning out for some of these AMCs. Mr. Harihar, coming back to you, do you like anything here? If at all, what can you tell us about this?
See, at present, if you look at it, there are only two listed AMCs, I would say pure AMCs. Now, one is, of course, Nippon Asset Management, the other is HDFC. Now, if you look at HDFC Asset Management, which is the larger of the two, I think very clearly the stock has become extremely overpriced. Now, I'll just give you a kind of a benchmark. Typically, if you look at any AMC, when an AMC is bought out or it's sold to a competitor or a larger fund, the average percentage of AUM that you get paid is about 8 to 9%, in the best case 10%.
Sure.
If you look at HDFC, I think 2 days back it was quoting about 22 times or 22% of the total AUM, which I think extremely stretched even by global and domestic standards. So I think at that point of time, you definitely have what I would call a certain kind of a resistance in the market. Relative to that, I think RNAM is, I would say, better priced. But then we need to really see whether Nippon Asset Management, under the new management after the exit of Anil Ambani, is able to get that kind of growth that Anil Ambani brought about 10 years back. That kind of a growth, whether it gets or not, is not clear at this point of time. And Japanese, businesses in India have known to be notoriously, I would say they have been failures in India. If you look at the Nikkos or the Daivas, they have really not managed to do anything much. So to what extent Nippon will succeed is something we need to see. What is my pick? I think I would rather look at a proxy. For example, take SBI. If you look at SBI, it has got a very strong asset management arm. The assets under management of SBI is, I think, number 3 after HDFC and Pro ICICI. And if you look at the equity AUM, SBI actually has an equity AUM that is more than HDFC. So since equity AUM is what drives the valuation, even assuming that SBI gets a valuation that is close to what HDFC or a little lesser than that, we are still looking at SBI having about a 2,80,000 crore overall market cap. 1 lakh crore comes from insurance, about 70,000 crores comes from mutual funds. So the core banking businesses for you available at about 1,20,000 crores. So we think that SBI could be a better play as a proxy for AMCs rather than buying the AMCs themselves.
Okay, fair enough. Well, point taken out there, Dinesh. So where do you see?
Yeah, so I would bet on HDFC AMC. Obviously the quality, the parentage, the management, the fund managers, the trust factor among retail consumers and so on and so forth is all there. Yes, it is trading at a high valuation compared to the other players, but this is a sector which is going to see significant amount of follow-on offers coming in from other players as well. And the financialization of assets and the savings and so on and so forth in the next few years, as well as looking at what AMFI is targeting in terms of the consumer base and the AUM base over the next 10 years in terms of the vision that they have rolled out. Obviously, HDFC is going to be the front bearer and one of the front bearers who's going to take the entire space ahead. So while it is still at a significant valuation, but if you're looking at a 3+ year horizon, then there's significant amount of value to get created. I would just reflect when HDFC AMC was, there was a debut on the IPO, and about 1600 odd levels, people were talking that it is expensive, but it has come at about 2900 odd levels, right? So I guess that the channelization of the savings towards the financial markets and the focus of AMFI that exists around, and the scale that this space is going to see going forward, I guess the next 3 to 5 years are pretty good in this space, and the dearth of a direct AMC holding being available in the market makes it even more lucrative because the parentage is quite good.
Right. But Dinesh, my question then is, it's already at around 2,900, 3,000 rupees per share. If you're holding it for about 3-4 years, I reckon that we are going with the assumption that the stock will at least double in the next 3 to 4 years. Is that what we are working with?
So yeah, in the sense, you know, that's the normal traditional model where we would reckon with in terms of the jump that would have. But if there is some amount of scale disruption that happens in the space, which is feasible in the next 3+ years time frame, right, then there will be a different set of parameters that will govern the scale in terms of the AUMs. I mean, today we have about close to about $350 billion of AUM, right? And AMFI is targeting about 1.4 trillion in the next 10 years, quadrupling the entire base, even 5 times, right, over the next 10 years. So if you look at that kind of a play, now not many sectors have that kind of growth and scale that is being targeted, right? And I guess all these things put into play, I don't see it not doubling in 3-4 years time frame.
Okay, fair enough. Well, that's your view here. On one side, we have a proxy play in State Bank, and the other one, of course, is HDFC AMC, which we all know has done spectacularly well of late. From there on, we move on to another very interesting stock, Info Edge. Again, one of the first few internet plays in the Indian stock market. It's been around for a while. Of course, it's into employment classifieds, along with the fact that now it's also into realty, along with matrimonials. Many may argue about valuations, and well, some may also suggest that it's a proxy play to perhaps a private equity, considering InfoEdge has a lot of other private equity investments. So let's pull this one up and talk about this. Mr. Harihar, what's your view here?
Broadly, I agree that it's a little stretched in valuations, but if you look at a pure e-commerce play in India, I don't see anyone other than probably a InfoEdge, which also goes with the code of Naukri.com, and the other one being IndiaMart. So other than these two, I think you really don't have too many e-commerce plays. So there is a certain shortage factor. Number two, I think InfoEdge, and full credit to Sanjeev Bikhchandani for that, is I think the way they have managed a very profitable business model for a fairly long time. Because I have been watching the numbers of this company, not only from the time it was listed, but even before it was listed. And they have at least managed to run a model which is not exactly fully scaled up, but I think it generates money on most of it. So be it the matrimonial website or be it the jobs website, I think they do manage to generate a good amount of profits. Because I remember meeting Sanjeev Bikhchandani once long back, and we had asked the question as to what is the connection between the job site and a marriage site, and the answer was, in India, the moment you get a job, the next thing you look at what is marriage. So it was a very wacky answer. But I think what we need to understand about this company is, notwithstanding valuation concerns, it has managed to sustain a profitable model. I don't know of too many e-commerce companies in India or anywhere abroad which has managed to sustain profitability for so long. So to that extent, I would believe that India is always going to be what I would call a job deficit market. There are going to be more people in search of jobs than jobs available. So to that extent, yes, since they operate largely in the lower and the middle segment, I would believe that even at these prices, the stock is a good bet.
Okay, Dinesh, do you agree?
Yeah, I would agree with him. I think this is one of the most high pedigree stocks, not only in this sector but across the markets. If you would see that, look at that. They are running the entire ship very efficiently. The profitability is good. The growth levels are high. Even in the down cycle that we are seeing, they have not been impacted as much.
Right.
And along with it, you have the flavor of a private equity kind of a play. And they have taken decent amount of stakes in some good pedigree startup ventures, and we have seen the way a Zomato and a Policy Bazaar has delivered value for them. And the other pieces they're getting into some decent, they're getting into logistics, shipping logistics, they're getting into a B2B shoemaker.
Right.
They're getting into some very interesting plays, and over the next few years, some of these can convert for them as the Zomatos and Policy Bazaars of the world, with a decent amount of stake in those organizations. So I guess you're investing into a private equity player, right, who knows how to play the game, right, who's done it for himself and who's able to get in the right set of investments, the right set of startup organizations. So I guess there isn't a parallel to this in India, and may not be as much globally as well.
But over the last few quarters, what they've started doing is reporting losses, because they're starting to take into account all the other subsidiaries in which they're... So doesn't the earnings per share bother you? That's one. The second one is that the gestation period for some of these investments is longer.
So this is more of an investment grade stock, because if you are looking at a proxy for private equity, then you need to look at a time horizon what a private equity guy would look at as. So this stock may not be valued based on PE basis, it has to be valued on an SOTP basis, and hence what is the sum total of all the investments that they would make over the next 7 years time frame. I would say that if somebody is venturing into this particular stock, you should look at a time horizon of 5 year plus. Only then it makes sense, because the value that you would accrue out of some of these investments would take more than 3 years. So 5 to 7 years time frame is what a good high pedigree investment in. But rather than putting into sectors where you do not know, here is something that you know what the history has been and what you can expect out of this piece. Okay.
Mr. Harihar, the management constantly comes up and says that we are linked to the economy, we don't necessarily know that the economy has turned for the worse, but that isn't something, and so far they have been resilient while the economic factors have deteriorated. The company has been resilient, so that is not something that you may feel that may deteriorate going forward.
No, so generally I think the job market is not something that is too cyclical, because as I said, normally what happens is when you have bad times, your mass retrenchments, and that only increases the need for jobs. So they are in the kind of a business where it's not likely to be very cyclical. I always say, in India, jobs and religion, they are two businesses that don't really go out of fashion very soon. So and they're not cyclical. So I don't think they need to really worry much about that.
Right. Okay. Well, there you have it. Prospects for InfoEdge at the end of the day look good, and for an investment, it certainly is up on the cards for at least two of our experts here on our panel. And from there onwards, we move on to yet another expensive stock. Looks like I've taken all the expensive stocks today. Avenue Supermarts. And this one, of course, is a retail play. Now, in the latest, we understand is that its promoter, Radhakishan Damani, is going to look to offload, about 5% more. But this is largely in adherence with the SEBI norms. So that is the only overhang at this point in time as far as this stock is concerned. He has time until the 31st of March to offload that 5% stake so as to bring it to the normed shareholding. That said, even after that, if you actually look at the valuations, it will still be right at the top of the list in terms of the way things are going as far as expenses are concerned. Dinesh, what's your view here? Where do you stand on Avenue Supermarts?
So we would recommend, if somebody is owning it, to stay into the stock, but we would not recommend to get into stock at these kind of valuations, extremely rich valuations. Their supernormal growth seems to be getting into some amount of normalization based on the last quarter results. Primarily, the dependence on the same store growth versus an expansion, drives in that direction. And since most of the stores are owned by Avenue Supermarts, there is a gestation cycle in terms of expansion.
Right.
They currently focus only on West and South. So there is an opportunity to get into North and East, but however, you need to understand those markets well. The different players who are getting into the retail space, larger players coming in, as well as online players getting into the phygital space, getting in offline and online and all that stuff. So the space is going to get far more competitive. While they do have a very optimized backend in terms of all that stuff, their inventory churn out is 1 month versus industry of 3 months and all that stuff. So there's a high pedigree execution that goes on. But looking at the current valuation, we would like to stay away. Whoever has it can hold it, right? But we do not expect any great run up from here.
All right. What about you, Mr. Harihar? Where you stand here?
No, I agree. Valuations are a worry, but having said that, if you look at a super efficient retail play in India, making a lot of money, growing consistently quarter on quarter, you really don't have too many options. It's probably the only stock you have. If you just trace the history of retail from the time the Future Group started as a listed entity about 18, 19 years back, I think most of them have followed the model of rentals, paying rentals, and then running the business. And most of them had a bad time in the down cycles. That is something I think Avenue Supermart has managed to get over, because the way DMart is structured is that it is not too bothered about rentals because they own most of their property. So I think that is one thing that has worked in their favor. Number two, if you look at it in terms of shelf efficiency, store efficiency, revenue per customer, revenue per store, they are top of the line. I don't think there's anybody close to that. I think what you said is right, that the money selling a 5% stake is going to be an overhang in terms of overall valuations. But I would believe that over the next probably 6 months, you should just keep nibbling around and using dips to buy the stock. I still think if you take a 4-5 year view, this is probably the one retail stock where I would be willing to put my money confidently and say that it will give me positive returns.
All right. Okay. Well, there you have it. That's your view on Supermarts, Avenue Supermarts. Dinesh, just a very quick follow up here. Some investors will argue that at 1400 the stock looked very expensive. We didn't buy it. It went to 1500. At 1500, though, we were like, we can't do anything about this now. There's no chance. From there on, it may have come on 1400, but they didn't buy because they wanted to wait until 1300.
That's right.
The thing is that the stock really doesn't give you a lot of chances to get in.
Yeah.
If you are seeing that if you already hold the stock, you hold on, but you don't get into these levels, how do you suppose the investors should go about it? Or do you just say that, yeah, abhi mujhe mere ye stock mein ye price mein nahi mila, I'm not going to buy it? Is that how you go about it?
So essentially, if you look at the band, it's between $1,400, $1,800 kind of stuff, right? So people who have love for the retail sector, right, they would want to get into it and stay back on that. But an investor who's neutral, who would want to look at any spare where he might see gains, then he may or may not want to get into this kind of a space, right? The love for retail sector and a long-term view, then you could look at, as Hari rightly said, look at the dips and then move in and then stay put and stay invested, because this is one of the best performing retail play.
Right.
And retail is going to scale up. Like my view on the AMC sector, this sector is also going to scale up, right? So from that context, if who have a love for this sector, they can get invested into on the dips. But if you're not in love with the sector, then might as well stay away.
Okay, well, there you have it. That's your view on Avenue Supermarts. Currently at around 1750, as you guys saw on your screen. And we'll continue to get you updates on that. But on that note, I am going to take a moment to thank both our experts here for joining us and taking us through the various stocks that we have spoken about. It was an absolute pleasure to have you guys. On that note, it's a wrap on this edition of Our Hot Money. But Ask BQ is up next. Stay tuned to BloombergQuint.